Well, guys, we have some critical news to talk about. The CPI inflation report has finally just come out, and it is been a bombshell report. Yes, we are now witnessing inflation acceleration to 9.1% year over year from 1.3% month over month. Now, although on the surface this report looks extremely poor, and this could mean an even more aggressive Fed over the next 2 years, there is a lot of context we need to put this report in because clearly the market is reacting to the downside, and there's still a lot of fear out there from retail investors as to whether or not we can actually get this rampant inflation under control. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So let's address the big elephant in the room first. As you can see, CPI came in at around 9.1%, which beats the consensus of 8.8%. Now, this could either be the fault of the Wall Street analysts that don't know how to predict inflation that was induced by a pandemic, or this could be more serious problems where inflation is much more sticky than we had initially anticipated. But if you look at the breakdown of inflation, there is some good news because we all know a lot of this inflation is just being driven by oil prices. As you can see, energy rose from 3.9 to 7.5%, which is obviously a very big component of the inflation CPI read. And food, on the other hand, actually went down slightly, right? And this is the same story across the board. If you look at some of the more core inflation metrics, something that the Fed actually looks at in the form of core PCE, which obviously came out a few weeks ago and came in quite nice, as you can see, it's not as bad as you think. Services inflation has stayed relatively stagnant over the past 3 months. It's been going between 0.6 and 0.7%. And the best part, most important part, is that used car prices are starting to fall down as well. They're starting to slow down a little bit, which again shows us that the work that the Fed is doing is starting to come into play. And it's a very similar story with the new vehicle index. Now, sure, this could be seasonal, but again, it shows us that this inflation, yet again, is being driven by crude oil prices, which rose at a very high rate. And obviously because the consumer is still spending a lot of money out there, even though interest rates have gone up. And the key thing to keep in mind is that although interest rates have gone up, the effects of those interest rates, at least to the average consumer, is going to take at least 4 to 6 months to actually take place. And obviously we only started raising rates anything significantly back in January and in March. So just keep that in mind before you make any sort of investment related decisions off of inflation data, which again, I don't personally do because none of this matters in the long term. In 2 years' time, we will completely forget about this inflation report, and this doesn't really have a big effect on the fundamentals of companies in the long term. As you can see, as of yesterday, the market did do quite well. We have seen a very strong risk on rally. This is something I talked about last week. ADN, which is one of the riskiest stocks in my portfolio, was up 10%, and even something like RMO was up quite significantly, which just goes to show that this market is realizing that longer term inflation expectations are starting to peak out, and with commodity prices collapsing, we could be on the verge of a near-term inflation peak. Now, this doesn't guarantee us that in 2023, the market is going to start rallying like crazy because there are going to be very big recessionary fears even next year. But again, it's something to keep in mind because inflation will not stay high forever. And at some point, even the Fed's actions are going to start taking place, and that's going to bring down consumer end demand. As for what should we expect from the overall market going into the next few weeks, well, since July has historically been a very bullish month for the market, I would still lean towards the upside right now, as long as we don't break below this 372 level, which obviously is a strong support from back in June. And the key idea here is that overall, longer term, this market is still looking pretty good because at the end of the day, consumer spending is a core component of GDP, and GDP is directly correlated with the performance of the stock market. All we're doing right now is we're trying to tame down the acceleration of the economy, meaning the economy is very strong. It's just that the inflation that has caused is a problem for the Fed. And that's something we want to keep in mind. We're not in a deflationary period like we saw in 2008, right? Or even in the 1960s when we saw money supply actually collapse. That is a bad thing. And that's why the Fed's long-term target is to have positive 2% inflation, which is a good thing. And this also brings me up into another important point, which many people don't realize, which is the fact that recessions often are extremely important buying opportunities. I know I've said this over the past month or so, but we already have a recession on our hands from the first and second quarter. Many people don't realize that. And that recession is driven primarily by rising inventories and production coming back online, which has reduced the amount of new inventories that need to be created. And obviously that affects the gross domestic output. And so even without the Fed's actions, we are already seeing a recession where inventories are going up. What does that tell us about the future over the next 24 months? Do we really think the Fed is going to need to be as aggressive as many people think it will have to be if the economy is already doing 90% of the work for the Fed by itself, right? Even mortgage rates are up at 6% almost. That's significantly higher from where we were 6 months ago, and that's much higher than how much the Fed fund rates has increased over the past 6 months. In addition to that, as you can see, we are seeing a big disparity in the sector performance of the market. Clearly, energy is benefiting from this, but a lot of other tech sectors in the communication, real estate, infotech, and discretionary space have been suffering. And the reality is that although the entire market might not move at all for the next 6 months, let's say, each one of these sectors will start to recover, because at some point we will have to even out if the market doesn't go anywhere for the next 6 months. If we go to the downside, yes, these sectors will perform even worse than all these sectors. But as we're already seeing in the market through something like the XPEV index, which, like I said last week, is one of the risk indicators of the market, we are starting to see money flow back into some of the higher risk stocks. These are not the QQQ NASDAQ related stocks. These are not those stocks. These are the very, very small cap stocks. Something like ADN, which is something I've talked about in the video that came out yesterday about how I own this in my portfolio. This is a $145 million market cap. And we're starting to see this play out across the entire market. We're starting to see a lot of biotech stocks move up. Now, sure, this could just be a short-term rally. But in my opinion, this is foreshadowing something that's yet to come for the rest of the market. The rest of the market might still have a rally left into it for the end of the year. Now, sure, in the short term, we could go lower. We could break all-time lows and then rally. But regardless, we will see some sort of relaxation in the market unless, obviously, the July or August print for CPI comes in over 10%. Because at that point, yes, the Fed will need to be more aggressive. So now that we are talking about the Fed, let's understand what the implications of this current CPI report actually are for the Fed and how this is going to affect them. And if I'll be honest, I don't think we're going to get that 100 basis point hike that many people have been talking about for the July meeting that's going to take place on the 26th. I think the 75, like we had all expected, is pretty much guaranteed because now we're slightly beating inflation expectations, and it didn't come in ridiculously high because I am sure that the Fed's board is looking at some of the leading indicators we're seeing that inventories are skyrocketing and that deflation is much closer to us than many people had expected. If you simply look at the margin debt, we have collapsed significantly since the start of the year, right? Although, yes, we have a little bit more left to the downside, and although this chart isn't updated, yes, we have collapsed significantly, which is a deleveraging situation, which is exactly what's going to cause us to bring inflation down. Following that, as you can see, retail inventories have literally skyrocketed over the past 6 months. Now, yes, this isn't going to be factored into CPI in 6 months' time or so. It's going to take at least a year for this to be factored in to CPI and start bringing down the overall inflation story. And we need to keep in mind that core PCE a few weeks ago came in much better than expected. That actually caused the market to rally a little bit. And as we all know, core PCE is significantly better of an indicator of inflation than CPI. And so that's something we also want to keep in mind if you're really trying to play this macroeconomic situation in the market today. As you can also see, because of the rising inflation, CPI has gone up, but that's also caused consumer sentiment to skyrocket to the downside, and we are literally sitting at all-time lows. And the good thing here to keep in mind is consumer sentiment being low is a good thing for inflation being down. It is a deflationary event. People tend to forget this. If people are not able to pay money at the pump, they're not going to spend money anywhere else either. And so although, yes, in the short term, this is not going to be immediately realized into CPI, it's going to take some time for this to happen. And overall, in the medium term, this is good to bring inflation down. As you can see, the periods of past where consumer sentiment was at all-time lows, we did see some sort of relaxation in inflation. Although it didn't happen immediately, it did take some time. And so that's something, again, we want to keep in mind, because overall, we're seeing a lot of sentiment shift from bullish to bearish in the market. And although in the short term that might pay off, it's just important to keep in mind that over the long term, that is something that's not going to affect the valuations of most stocks. And instead, you want to be taking the advantage and buying the dip on your favorite companies during this market volatility. Here's another important thing to keep in mind. We're starting to see repos significantly go higher, right? We are starting to see inventories come back on the market from people that could not afford the cars that they bought throughout 2020 and 2021, which obviously is also going to bring down the used car and new car price index on the CPI, which is another big component of that specific report. And so overall, yes, this report in the short term just tells us that we are still at a pretty bad situation for inflation and that it's not going to get better anytime soon. We are starting to see some leading indicators show us the pivotal moment at which inflation will start to inflect. And just keep this in mind, guys, that by the time inflation inflects and everything is back to normal, chances are that the stock market might actually just be at all-time highs by that time. Many people don't talk about this, but if inflation is something that people are looking for to improve before they buy stocks, chances are that the market's going to be at all-time highs when the situation gets extremely good. And so keep in mind that most people are still selling right now, and that is creating an opportunity, because we all know inflation is not going to stay here forever. If you're trading call options, put options, or swing trading, then yes, this is a good thing for you because it creates more volatility. But as a long-term investor, this is creating also is an opportunity, even though in the short term, it feels like it's not creating an opportunity and that the market is going to continue to go even lower. But as usual, guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below what you guys are doing with this inflation report. Again, my thesis stays the same. I'm continuing to average down on my main positions. And I do think we are headed into a deflationary period sooner rather than later, even though in the short term, it's very painful. But as usual, guys, make sure to drop me a thumbs up, and I'll catch you guys in the next one. Take care.